They're in a pretty defensive sector overall. And then you factor in, can they grow their margins and can management execute? And that's going to be the biggest question on CVS. Welcome back in, everybody. So there is a lot of things taking place today. We're going to get into the macro down to individual stocks. I want to touch on the labor market, Apple's historic buyback, CVS's largest problem, and the Fortunet miss. So make sure you like and subscribe, hit that bell, and let's get into it. U.S. economy adds 175,000 jobs in April, much fewer than expected, and this is a good signal for the market. The soft landing scenario, the Goldilocks situation that the market's looking for, and so markets are definitely up on this, and they're not just only up on this, but specifically, the NASDAQ is leading the way, up over 1.5%, which is the historical buyback that Apple just made, and the fact that they're guiding for future growth here, which we all know over the last 3 years, Apple's revenue hasn't really grown too much, but now there's a reacceleration of possible low single-digit growth on top of a historical buyback, and that is sending markets up. And so we know that those historic saving rates are coming down, but now I want to talk about unemployment here, as it does peak to 3.9% unemployment, which is still historically low, but I want to just show you that it is trajecting up here, going from 3.3% unemployment now to 3.9% unemployment. And when we topple that with the average hours worked here, coming in at 34.3 hours worked, and that's coming down from 34.4 hours worked. So the combination of unemployment ticking up and hours coming down is kind of what we're keeping an eye on. I don't think this is any sort of dangerous territory, but the trend is now starting to go in a different direction, and I just want to bring that to your attention. As we saw from unemployment, it's starting to tick up, and when we see total hours worked coming down from 35 hours a week worked down to 34.3 hours a week worked, to me is sending a signal that with savings rates coming down, the consumer is definitely going to be even more stretched if this trend continues. So kind of just wanted to show you the macros that are taking place here. I don't think it's a hit the alarm quite yet, but I just want to show you that the trend is trending in an interesting direction while the labor market is cooling, which means that there's going to be less jobs available, and we know the savings rates are coming down. So the combination of all those things, to me, is signaling pay attention to this stuff, which is now going to lead us to the historical drop that CVS had, going from nearly $68 a share down to $55 a share, completely steamrolling all investors. And I can definitely see that people probably have a bad taste in their mouth. But I really want us to take a step back here, be open-minded, and look at this as, is this an opportunity or is this a problem? Let's talk through the earnings really quick. Now, we look at GAAP earnings coming down roughly 50%. This is a stock that was trading for over $100 at the peak, now trading in the 50s. And we can see that earnings are following stock price, or stock price is following earnings here. As those earnings are deteriorating, costs are going up, we're seeing that impact the stock price. This is really, to me, coming down to, are we going to trust management to execute? And I'm going to show you multiple reasons why that is. This management itself has been kind of not executing at all. There's been tremendous acquisitions, tremendous levers that can be pulled in this business, is which attracts me to it. And the fact that they're still on a growth path here, even with bad things happening. When we look at the revised full 2024 adjusted earnings, we're looking at $7 a share. And while there is a lot of bad here, I do want to point out some strengths about the company. First and foremost, they lost their largest client. And not only did they lose their largest client, but they were still able to grow top-line revenue over 3%, going from $85 billion of top-line revenue for the quarter to now in this year doing $88.4 billion in top-line revenue. And when I look at this, this is pretty powerful stuff. First and foremost, there's not many companies doing $80 billion of revenue a quarter, but then to be able to still grow when you're in a mature phase of your business cycle, be able to still grow these types of figures is pretty powerful things. And the one thing I want to point out here is premiums jumped up substantially, going from $24 billion in premiums to $30.4 billion in premiums. So the aspect of the business where the reoccurring revenue comes in is going to be premiums, and they're growing that reoccurring revenue. But where the rubber meets the road and where CVS is having its largest problems is actually not with running the business. It's the healthcare costs skyrocketing on them. They saw healthcare costs go from $20.4 billion in healthcare costs to now $27.8 billion in healthcare costs. And this is where it's dragging all the metrics down on the fundamentals on this company. is these healthcare costs. So it's kind of a twofold question here. Number one, can they outgrow the premiums and get the healthcare costs under control? If that is a yes, then this could be an absolute steal for a stock and a compounder. As you guys know, I thought underneath 56 was kind of a steal here. And with adjusted earnings coming in at $7 a share and probably on a GAAP basis coming in between $4.50 and $5 a share, you're looking at a stock that's basically trading between 7 to 12 times earnings, and that's still growing top line revenue. We look at what they're earning per share versus that dividend yield. This is where I get a little nervous. Earnings do have to turn around here. And the nice thing is that if they can turn their earnings around, and this is kind of a kitchen sink type earnings like we got from Pfizer, this would definitely be a long-term buying opportunity. The big question is going to be, can they outgrow the premiums and get the control cost of healthcare costs down? A lot of people were going to doctors. The costs by themselves are up. So is this a wave of just people getting healthy? And will summertime kind of lead us to expanding margins once again? This is going to be, can management execute? And this is where one of the hardest things to put a price on is betting on management, because to me, all the fundamentals and the capabilities of running a great company are there. Great top line revenue growth. They're in a pretty defensive sector overall. And then you factor in, can they grow their margins and can management execute? And that's going to be the biggest question on CVS, which is now going to lead us to Fortunet. And this is a stock that I've been personally keeping an eye on. Cybersecurity, from a valuation standpoint, I actually think this is one of the more reasonable ones out there, even though it still trades for a ridiculous valuation. But we can see here that a nearly 8% fall from reporting earnings. Even worse than Fortunet is going to be Cloudflare, which reported earnings and is down nearly 18% on the day. So these are substantial moves that we're seeing in the markets. And this is why we've been saying this has been a stock picker's market here. We're seeing some companies actually outperform that are in the same sector, and other companies really fall from the hip side. I think we can look at something like Starbucks as being another one that was pretty interesting as well. Definitely getting into an interesting buy zone for me personally. I want to readjust Fortinet projections here because this is one that I've definitely had an eye on, and it's still growing, but it's not growing to the speed that the market was anticipating, and so we're seeing that pullback here. Now, for me personally, what I want to do in my valuation for Fortinet is get an idea what they're projecting 2024 to look like, and then lower their growth rates to get an ideal price target on this company. So this is all I'm really looking for Fortinet to see if it's even worth digging into, is this full year guidance here. They anticipate to do $5.745 billion to $5.845 billion. So let's plug in these numbers and kind of see where we're at for our price target on Fortinet. So I had them projected to do right around $5.9 billion of revenue. So we're going to discount this to get it to that $5.75 billion mark. If I'm looking for over a 10% rate of return, me personally, I need to be buying the stock probably around 32 to 33 bucks a share. And so, this might be one that I just can never get into. It seems like these cybersecurity stocks have been trading for extreme valuations, but I want to show you what I've done or why I'm attracted to Cisco Systems here. Okay, so a few reasons why I am attracted to Cisco Systems versus jumping in these higher flyers when it comes to cybersecurity. A lot of these companies, as we can see, can dive down 17, 20, 30% on a given day because the growth rates are slowing and it's just missing Wall Street's expectations. So the pullback effect on it is pretty drastic for a lot of these companies. But a hidden gem that I think is happening here is Cisco Systems has acquired Splunk and about 4 or 5 other cybersecurity companies kind of under the radar here. They bought them mainly for cash, so they're not taking any toxic debt on. And when I look at the valuation of Cisco trading right around 14 times earnings and paying a 3.4% dividend, and understanding that they're acquiring these higher multiple type companies and putting them in their business model with a great reputation backing them, I actually think they have a pretty substantial opportunity in the cybersecurity industry to really grow their margins and become a compounder here. And so this is how I'm kind of playing cybersecurity from a distance. I'm leveraging Cisco's balance sheet and the other opportunities that Cisco has in their business model, and them acquiring these high-flying companies for cash and still keeping a low multiple on the stock, to me, is kind of the interesting setup here for Cisco. Now, of course, this could be a company that, blows up in my face and it doesn't turn out to do anything. But when we look at kind of valuation on the company, Cisco to me is pretty close to being a buy regardless, and I believe I factored in the addition to Splunk on this and my projections out on Splunk here. So Cisco to me around that $40 to $45 mark is pretty enticing. We did reach a little bit on it. I think we're in a little bit in the higher 46s. So for me, this is an interesting one and kind of a way to play cybersecurity from a distance without all the volatility, because you have the Cisco side of the business, their legacy side of the business, that I think has a pretty substantial growth path as well with all the AI build out that's going to be needed. So I think you really have a big opportunity here for Cisco to be something a little bit more special than the market's pricing in. So it's giving me that exposure to cybersecurity, but without paying that premium. And so that's kind of how I'm playing Cisco here. And so guys, hopefully you all enjoyed that, and we will see you in the next one.